what is the cue for the market when it comes to the earnings as well? We'll discuss all of that. But first up, Shibani Sircar Kurian joins us on the show. Shibani, as far as the earnings season right now, the way it has panned out, what's your key takeaway? Do you think it's just the financials which are showing outperformance? Because other than that, there hasn't been a massive re-rating anywhere that we have seen.
Hi, good afternoon. So yes, still early days in the quarterly earnings season. So what we have seen is at a headline Nifty level, numbers have been pretty much in line with estimates. Of course, what we are also seeing across companies is that margin expansion is now playing out with input costs coming off. And as you rightly pointed out, most of the earnings that have come are largely financials and the IT sector. So IT sector, we have seen a muted set of numbers, but that was again more or less in line with estimates. For financials, I think the numbers and the overall earnings trend continues to be fairly robust. While there was expectation of margin decline from the peak that we saw in the last quarter, which is the fourth quarter of FY23, margin decline has not been as stark or as sharp as what was initially feared, and overall margins have been holding up. More importantly, credit growth has been strong, which means that that is supporting core earnings. And asset quality trends continue to remain fairly stable and benign, which is also supporting earnings. So I think as of now, the earnings season has been panning out pretty much in line with estimates. Financials continue to show fairly strong numbers, especially some of the private sector banks which have reported numbers so far. Overall, pretty much a good set of numbers.
Just wanted to get your sense in, Shibani, on, L&T and the entire cap goods space, because one part of the market does believe that some of these stocks are richly valued, and then you have a performance like you did from L&T. Fabulous numbers, the order inflow looks very strong, order book position that is, and then of course the buyback, the first of its kind.
Positive on the entire capital goods space. And while you are right that in pockets, valuations are looking a little stretched or expensive. However, we believe that the overall trajectory of growth, especially given the kind of order flow momentum that we have seen, continues to remain strong. What we also believe is that there is likelihood of very steady growth where the overall industrial pack is concerned. Of course, supported initially, as we have seen so far, by public capex, and incrementally we do believe that private sector capex is also likely to kick in, which is what is supporting the kind of growth expectations that we have within the space. So the entire pack of manufacturing, capital goods and infrastructure is a segment within the overall domestic basket where we believe that the kind of growth momentum should continue. The second aspect is margins. Incrementally, we believe that margins should also start to improve with input cost pressures coming off, and therefore the earnings trajectory should also be fairly healthy. We are mindful of valuations within the space, so therefore we are looking at opportunity sets within the industrials capital goods space where valuations are still reasonable, but the earnings trajectory remains strong.
Hang in there. We'll just come right back to you, but after this very short break.